Sometimes as an investor, you need to act proactively, not just reacting to market events. It's necessary you take proactive actions so as to be able to benefit from future market events. And so in this video, I want to talk about how to identify companies that are likely to announce stock buybacks. How do we identify companies that are likely to announce stock buybacks in the future? So identifying companies that are likely to announce stock buybacks requires assessing certain financial and strategic indicators. So here are key factors to consider. Number one is strong cash flow. There should be strong cash flow. Companies with robust cash flow and a strong profit generation are more likely to have the resources to repurchase or to buy back their shares. So look for companies that consistently report healthy operating cash flow and profitability. When there's that consistent and even increasing cash flow, operating cash flow, that company has a likelihood of buying back its shares. Number three is an excess cash or low debt. Excess cash or low debt. Firms with an excess cash reserve or low level of debt may be more inclined to buy back shares. They are in a position to allocate capital towards buybacks without compromising financial stability or future growth or future growth investments. Number three is undervalued stocks. If a company has if the company stocks are considered undervalued, if a company believes its stocks is undervalued, it may choose to repurchase shares as a way to take advantage of what it sees as market inefficiency. So look for companies whose stock price is below intrinsic value or where management has made public statements suggesting they believe their stock is undervalued. Number four, strong earnings and profit margins. Strong earnings and profit margins. So companies with solid earning growth and healthy profit margins are more likely to initiate buybacks. Discover that the earning is growing year in, year out, and the profit margin is keeps on improving. That's a very good candidate. So strong profitability provides the necessary financial foundation for repurchasing shares. The company is making solid profits, and not only just making profit, but the profit margin is equally increasing. And the earning per share is equally, on an increase. So that's a good candidate. Number five is shareholder-friendly management. Shareholder-friendly management. So compared companies with solid earning growth, you should take that into consideration. Not only just increasing earnings and making profit, but is the company shareholder friendly? That is it. So usually companies with a history of returning capital back to shareholders, either through dividends or buybacks, are more likely to announce future repurchase. What have they been doing in the past? Then they are likely to extend that goodwill into the future. So if they have have a history of returning or favoring shareholders by paying regular dividends, then of course this company has the likelihood of repurchasing shares in the future. So review past buyback activity and any forward-looking statements from management regarding shareholders' returns. You put your ears to the ground. What is the company saying concerning future share buybacks? Number six, stable or declining capital expenditure. Stable or declining capital expenditure. If a company is not investing heavily in capital expenditure or growth opportunities, it may choose to return excess capital to shareholders. So companies with lower capital expenditure requirements may have more cash available for buybacks if its expenditure is not as much as what is lower than the available cash. Then the company may decide to return the cash back to its shareholders through buybacks. Number 7, tax efficiency strategy. Tax efficiency strategy. In an environment where capital gains tax rates are more favorable than dividend tax rates, so companies may prefer buyback as a more tax-efficient method of returning capital to shareholders. In the case where dividends are taxed at a higher rate than capital gain tax, then share buyback is a very important. It's a preferred option of favoring shareholders in a tax-efficient way. Number 8, positive financial health indicators. Positive financial health indicators. We look for companies with strong balance sheets, low debt to equity ratios, and high returns on equity. These companies are generally in good position to implement stock buyback. You look at very good returns on earning, returns on equity, low debt, strong balance sheets. They are likely to announce share buybacks. And number 9, positive market conditions. Positive market conditions. In favorable market conditions, particularly during periods of economic growth, companies may be more likely to announce buybacks to enhance shareholder value and to take advantage of higher stock prices. Then number 10, insider activity and management statements. Insider activity and management statements. So you monitor insider buying activity and statements from management, as they may provide hints about the company's confidence in its stock's price and future prospects. What is the management doing? Are they really buying shares, or are they selling shares? So these are hints as to whether the company could likely buy back its shares or not. So if executives or board members express confidence in the company's valuation, the buyback could be more likely. So by analyzing these factors, investors can identify companies that are more likely to announce stock buybacks, signaling potential opportunities for long-term value creation. So then you consider all these factors and they give you that particular positive signals. It shows that the company will likely buy back shares in future. So you invest, the company could do well. That's what prompted Warren Buffett to buy shares in IBM, although he later sold the shares. There was that belief that IBM would repurchase its shares, although the company later fell out of favor with investors. But that was what really prompted him to buy into IBM. It was a costly mistake indeed.